In the late 1990s, Enron wasn't just another energy company. It was considered one of the smartest businesses in America. Investors loved it, Wall Street praised it, politicians admired it, business schools studied it. At its peak, Enron was worth more than $70 billion. Thousands of employees believed they were working for the future. Then, almost overnight, everything collapsed. In just a few weeks, Enron went from being one of America's most respected companies to filing for what was then the largest bankruptcy in U.S. history. More than $60 billion in shareholder value disappeared. Thousands of people lost their jobs. Employees watched their retirement savings vanish. One of the world's largest accounting firms disappeared with it, but Enron didn't collapse because oil prices crashed or because customers disappeared. It collapsed because much of its success had been an illusion. This is the story of how Enron fooled Wall Street and how one of the biggest corporate frauds in history finally came crashing down. Enron began in 1985 after the merger of Houston Natural Gas and Internorth. The new company was led by Kenneth Lay, a charismatic executive who believed the future of energy wasn't simply producing gas or electricity, it was trading them like financial assets. During the 1990s, the U.S. government deregulated many energy markets, creating enormous opportunities. Enron quickly transformed itself from a pipeline operator into an energy trading powerhouse. Instead of making money by transporting natural gas, Enron connected buyers and sellers while earning fees from every transaction. The company expanded into electricity, broadband, weather, derivatives, water utilities, and even internet bandwidth. Investors loved the story. Every year, Enron announced new businesses that promised explosive growth. Fortune magazine named Enron America's most innovative company for 6 consecutive years. Its stock price soared from under $10 in the early 1990s to over $90 by August 2000. Everyone wanted a piece of Enron, but behind the scenes, the numbers told a different story. Many of Enron's new businesses weren't making money. Some projects lost millions of dollars. Others never generated meaningful revenue at all. Normally, companies would report these losses to investors. Enron chose another path. The company adopted an accounting method called mark-to-market accounting. Instead of recording profits when cash actually arrived, Enron estimated how much profit a project might generate over many years. Those estimated future profits were booked immediately. Imagine signing a 20-year contract today and recording 20 years of expected income as today's profit. Even if the customer eventually paid less or never paid at all, the profits had already appeared in the financial statements. On paper, Enron looked incredibly profitable. In reality, much of that profit existed only as optimistic forecasts. When projects performed poorly, executives faced a difficult choice: reveal the losses or hide them. They chose to hide them. Chief Financial Officer Andrew Fastow designed hundreds of complex partnerships known as special purpose entities, or SPEs. These partnerships allowed Enron to move billions of dollars in debt off its balance sheet. The debt didn't disappear. It was simply moved somewhere investors couldn't easily see. As long as Enron's stock price kept rising, the system appeared to work. The company borrowed more money, created more partnerships, reported higher profits. Wall Street rewarded Enron with an even higher stock price. It became a dangerous cycle built entirely on confidence. Inside the company, the culture made things even worse. Enron encouraged extreme competition among employees. Managers ranked workers every year. The lowest performers were fired. Employees quickly learned that producing impressive numbers mattered far more than asking difficult questions. Aggressive risk-taking became normal. Success was celebrated, failure was punished. Executives received enormous bonuses tied to short-term stock performance. The higher the stock price climbed, the richer they became. There was little incentive to think about the company's long-term health. Outside the company, almost no one challenged Enron's financial reports. Investment banks continued recommending the stock. Credit rating agencies maintained strong ratings. Auditor Arthur Andersen approved Enron's accounting, despite clear warning signs. The system that was supposed to protect investors instead helped reinforce the illusion. Eventually, however, reality caught up. In 2001, journalist Bethany McLean published an article asking a simple question: how exactly does Enron make its money? Few people could answer. Around the same time, Analyst skepticism increased. Investors began examining Enron's complicated financial statements more carefully. The company struggled to explain them. In August 2001, CEO Jeffrey Skilling unexpectedly resigned after only a few months in the role. Officially, he cited personal reasons. The announcement shocked Wall Street. If Enron was as healthy as it claimed, why would its CEO suddenly leave? Soon after, internal whistleblower Sherron Watkins warned Kenneth Lay that the company's accounting practices could destroy Enron. Her concerns proved accurate. By October 2001, Enron announced massive losses and revealed billions of dollars in hidden debt. Investor confidence collapsed almost instantly. The stock price entered freefall. Banks demanded repayment. Trading partners stopped doing business with Enron. Customers lost trust. Potential buyers walked away. In November, Enron attempted to merge with rival energy company Denegi. The deal could have saved the company, but once Denegi reviewed Enron's finances, it withdrew. Without new funding, Enron had no path forward. On the 2nd of December 2001, Enron filed for bankruptcy. Thousands of employees arrived at work only to discover their careers were over. Many had invested their retirement savings almost entirely in Enron stock. As the share price fell from over $90 to less than $1, years of savings disappeared. Meanwhile, many executives had already sold millions of dollars worth of shares before the collapse. The public outrage was enormous. Investigations followed almost immediately. Kenneth Lay and Jeffrey Skilling were charged with fraud and conspiracy. Andrew Fastow pleaded guilty and cooperated with prosecutors. Arthur Andersen, one of the world's largest accounting firms, was convicted of obstructing justice for destroying audit documents. Although that conviction was later overturned, the damage was irreversible. Arthur Andersen collapsed, ending nearly 90 years of history. The Enron scandal fundamentally changed corporate America. In 2002, the U.S. passed the Sarbanes-Oxley Act, introducing stricter financial reporting rules, stronger corporate governance, and tougher penalties for accounting fraud. Public companies faced far greater scrutiny. Auditors became more independent. Executives became personally responsible for the accuracy of financial statements. Enron became a permanent warning. Its name is now synonymous with corporate fraud. Even today, business schools continue teaching the Enron case because it wasn't simply an accounting scandal. It was a failure of leadership, ethics, incentives, oversight, and corporate culture. No single person caused Enron's collapse. Executives manipulated financial statements. Auditors failed to challenge them. Banks enabled questionable transactions. Analysts ignored obvious risks. Investors trusted numbers they didn't fully understand. Everyone assumed someone else had done the necessary checks. That assumption proved catastrophic. The Enron story reminds us that impressive growth doesn't always mean a healthy business complex. Financial statements can hide simple truths. When a company becomes too difficult to understand, investors should become more, not less skeptical. Because sometimes the biggest companies aren't built on solid foundations. Sometimes they are built on illusions. And when reality finally arrives, those illusions disappear faster than anyone expects.